This conference will now be recorded.
Okay, assuming there are no questions, let's begin working through where we're going with the course. And we begin with the financial accounting theoretical framework. And the basic thing that we do in accounting and what you've got to do, learn how to do, is to prepare an income statement, a statement of retained earnings, a balance sheet, and a statement of cash flow. And we do these three at midterm by midterm, and then we get to the statement after midterm. But this always is what we're trying to do. You're going to learn how to prepare an income statement, a statement of retained earnings, and a balance sheet for a company by midterm, and then the statement of cash flow. That's the purpose of accounting, to prepare financial statements so you can understand for a company how much income did it make, how much of the income did it retain in the business, what are its balance sheets. Now, you personally got an income statement. If you work, you have income. You have a balance sheet. You have assets, liabilities, and the difference is your equity. And of course, how your cash flow back and forth. So you do this, but for a company, for companies, we have to have these statements. Because why do we need these statements? We have internal users and we have external users. Investors, you make a decision to invest in a company based on the financial statements. That's what the decisions are made on. Creditors loan money to companies based on the financial statements. Tax authorities, financial statements. Then employees. Before you go work for a company, you should look at its financial statements to understand, okay, is this company profitable? So before you go to work for a company, any company, or if you work for a company, look at this financial statements. How is it doing financially? So all of these people need these financial statements. And so when they're making a decision, do I invest in this company? Do I go work for this company? You look at these financial statements. So we're learning how to prepare these financial statements, and then we'll get some understanding of these financial statements. But everything is about the money. The federal government, money. The state, money. Texas Southern University, money. You, money. So I don't care where you're working. If you're going to be in top manage something, you got to understand the money. So this is why this is a sophomore course. It's one of the first courses you're supposed to take, or some people delay. But you got to, this is the heart and soul of all business, the money. Just like the heart and soul of you is your money. So even for non-business majors, you'll find that healthcare majors, they take the first accounting class. Why? The healthcare agency got to make money. They have to figure out how to make money. The university has prepared financial statements, so on and on and on. So everything revolves around money. So it's adding and subtracting. You just have to learn how to do that. There are some generally accepted accounting principles, and the Securities and Exchange Commission is mainly responsible for it, but they delegate this to the FASB, General Accounting Standards Boards. Then there's an International Accounting Standards Board. We will come back to this after midterm. I'm just introducing you to it now. There's 15 key accounting principles. First one, the business as a single entity concept is separate from you. So when you're running a business or a company, it's separate from its owners. So this talks about the types of businesses, specific currency, we got to use money, convert it to dollars if it's not. Time periods, historical costs. We record stuff as historical costs. We have to have full disclosure. There's 15 of these. Once again, I will come back to these at midterm, or after midterm, once we get our statements prepared, and we'll get a better sense of it. All businesses have a chart of accounts that consists of assets, liabilities, the owner's equity, revenues, and expenses. And so I just have these listed. What are assets? So you know you can come back here and refer to it. What are liabilities? Stockholders' equity, treasury stock, revenues, and expenses. So this is just a reference section for you where I've got to find all of the various types of accounts. So all businesses, and of course you're making a copy of that chart of accounts, but all businesses are going to have assets, liabilities, they're going to have some owner's equity, income, and expenses. So just in case you see something and you don't understand, you can come back here. So this is just a reference section for you. This is an income statement: revenues less expenses, net income. This is what you're going to be able to do by midterm. Statement of retained earnings: how much of that income we kept in the business, and then a balance sheet: assets. What are the assets? What are the liabilities? What are the retained earnings? So you're going to be able to prepare these 3 statements, and we have a process to get you to that. Okay. Okay. Are there any questions so far?
I have one question. I just want to know, did you post that document that you're on right now, in course content? If so, I could not find it.
Yeah, I think I said most of this is in course content. But
Okay, I just.
it's also in the primer that you buy. See, so all of this is in that primer. So I teach from this primer. So I put the first ones in there. So if you don't have it and everything, so you got this information there preliminarily, but you should have your primer. And so you're just following along, making notes and everything. I'd say get the hard copy, especially if you're an accounting and finance major, but they do have it virtually also. Okay.
Okay, so all these, everything that you're showing us right now is in this book right here?
Let's see, where are you? See if I can find.
Uh,
Let me see where you are.
Are you looking by name? My name's Kennedy.
Let's see. I don't see your picture though.
Oh, let me share it. Okay, can you see it now?
Got it now. That's it.
Okay, so everything that you're talking about is in this book.
Yeah.
Okay, thank you.
You're welcome. Now, a key in accounting is you got to think entrepreneurially. Like I'm running a business. It's nice to be able to go out and buy things, but it's better to be focused on, I'm going to create things, change the world, own and operate a business, and then I'll spend the money that I make from running that business. And there are a lot of businesses that are starting up anew, uh, given now new changing order, you know, with and after the pandemic. With a business, you need a business plan in terms of what you're going to do. And if you want to start a corporation, you have to have a corporate name. You have to draft some articles of incorporation. And these are, standard state document, have an organization, try and get an ID number, maintain corporate minutes, and issue shares of stock. So remember, we talked about the fact that a company is separate from its owners. And so when you start a company, you give your money to the company. That's the first thing that you do. And you get a stock certificate which says, okay, you gave this much money to the company, and this is your evidence of this money. Your money is in the bank. And once your money goes into your corporate bank account and you get stock, it has to stay there. You can't just take money out. So if you go invest in a company, you can sell your stock, but you cannot ask for the money back. But this is the evidence of it. So that's what a stock certificate, simple one looks like. So when we're creating our business and we've written our business plan and got a corporate name and created an organizational chart, issued our stock, then our company's got to prepare these 4 financial statements. It has to prepare these 4 financial statements. Okay? So how do we prepare these 4 financial statements? How do we do that? We have, first of all, the accounting equation, assets equal liabilities plus stockholders' equity. Stockholders' equity is common stock plus retained earnings. Retained earnings is revenues minus expenses minus dividend. This is the fundamental accounting equation that governs everything we do. And of course, you should be familiar with that equation. You should be familiar with that equation. Expand the equation a little bit. Cash plus other asset equal liabilities plus common stock plus retained earnings. If we put $100,000 into a business, we will have evidence of that by the common stock, okay, that we have. The purpose of a business is always to increase the cash through its earnings. So you start a company and you put cash in, you put $100,000 in. What you need to do and what other investors and banks are going to want to see is that, did you increase your cash through earnings? So always just keep that in mind in terms of what we're trying to do. Long time ago, 1400s, this guy Pacioli, who's kind of the father of accounting, came up with this double entry system for transaction. And what he said is that when there's a transaction, there's 2 parties. And in any transaction, you receive something, that's a debit. You give up something, that's a credit. So he came up with this double entry system of accounting, that every time there's a transaction, there's 2 parties. And when you receive something, it's a debit. When you give something up, it's a credit. If you go to the grocery store, there are 2 parties. You get food, you give up cash. For the grocery store, they get cash and they give up their groceries, their inventory. So everything is always double entry. So always keep in mind that whenever there's a financial transaction, there's two sides of it. There's a debit side of what you receive, and there's a credit side of what you give up. So whenever we make a journal entry, there's always two sides to it. Return to our accounting equation, and we'll review this next time. We're just hitting it quickly. Assets are things that we get, and so they have debit balances. Liabilities are things we give up. The company creates a liability or it creates common stock. Those are credits. Earnings are credits. Retained earnings, hopefully, are credit. Revenues are credits. Expenses and dividends are debits. Now, on this left side of the equation, debits are good. On the right side, the credits for common stock and retained earnings and revenues are good. Debits are not that good. It's just like when you pay your rent. Yep, you do give up something, your cash, and that's a debit transaction if you're running a company, but you have to do it. So we're just saying that assets, when they have debits, liabilities have a credits, common stocks credit, retained earnings credits. Revenues are credit, expenses and dividends are debits. Suppose I showed these transactions to you and I asked you how much money I got. That is, if I had 50, 10, 15, 3, 15, 4, 2, 2, 8. And I asked you to tell me how much cash I got. How much cash would I have? So this was your business and you start off with 50,000 in cash. You paid out 10 and 15 and 3. You got 15 in, you paid out 4 and 2. You got 2 in and you paid out 8. How much cash do you now have? Anybody know how much cash they have?
$2,700. Okay.
How much?
2,700.
Hope you got more than 2,700.
Is it 1,000? 27,000.
27,000, you say?
25,000.
5,000, somebody says. You see once again now why we use debits and credits also. When cash is coming in, when it's a plus, it's a debit, and when it goes out, minus credit. We can go here and say, okay. Anytime cash came in, we put on this side, 15 and 2. Anytime cash went out, we put it on the credit side. Debit, we add the credits, and that gives us our account balance. Any questions? Does everyone see that? So let's just take this information down. Let's see if we can copy it. So I just put all of that information in this Excel spreadsheet, okay? So let's see if we can determine how much cash we got, with Excel. Let's show you why we use Excel. So I can go through here and highlight these and hit auto sum. Then I can go through here and highlight all the credits and hit auto sum. That's what Excel does for us. See how simple that is? So rather than you being on a cell phone or whatever, that's why we're going to use Excel. And if we want to get our balance, we can do a little equation. And the equation always starts off with a equal. Then we put a parenthesis here. Then we're going to click on this 67,000. Then we're going to put a minus in. Then we're going to click on the 42,000. Then we're going to close our parentheses. How about that? Does everyone see that? What we did with Excel? So when we finish this course, you're going to be proficient at doing that, doing your financial statements. And our goal, of course, is always what? We want to learn more, be able to do more. Let's begin to look at transactions. Suppose we buy a car, and in the first situation, we paid $10,000 for the car. Our debit is to the account Auto. We debit Auto 10,000, and we're going to credit cash 10,000. Okay. We got an Auto, and we paid cash at 10,000. In the second scenario, we gave a note to buy the car. We debit cash, but now we're going to credit notes payable. Okay. So same Auto, but the way we purchased it was a different way. And finally, we paid $2,000 down and gave a note for the balance. Debit Auto, credit cash, credit notes payable. So every time there's a financial transaction, we got to make a journal entry like this, where we debit something and we credit something. There's always at least two accounts, and the debits and credits are always equal. Okay. Let's move to the accounting cycle. So to get to where we want to be, preparing these financial statements, step 7. For the first 2 weeks, we're just going to do steps 1 and 2. We're going to analyze transactions and make journal entries. That's all we're going to do for 2 weeks. Because if you can't do steps 1 and 2, you can't come over here to 3, 4, 5, 6, and 7. So I want to make sure that you know how to do steps 1 and 2. So we do it for 2 weeks. So there's no excuse why you cannot make journal entries. Okay. That's all we're going to do for these first 2 weeks. So your first quiz will be on making journal entries. Step 1, make a journal entry. Every time a company has a financial transaction, it's got to record it. Each journal entry requires an equal debit and credit. You read the financial transaction, determine what type of journal entry required from the transaction type. So we're going to get to that in a second. When we have an asset, if it goes up, we debit it. If it goes down, we credit it. Assets should have a normal balance of a debit. Let's go to liabilities. When we create a liability, it's a credit. When we pay on it, it's a debit, but its balance should be a credit. Common stock. When we issue common stock, it's a credit. Suddenly we have debit. Its balance should be a credit at the end of the day. And retained earnings. If it's a credit, the company's doing well. If it's a debit, the company's not doing too well. Revenues always are credits. Revenues are always on the credit side. Expenses and dividends are basically always on the debit side. So we'll go back over this, but this is just the rules of debits and credits. Now, what I've done, and what's not in textbooks a lot of time, I have created a chart, which I told you to make a copy of the 20 journal entries that we work on in this class. Now, for this first 2 weeks, you only got to do the ones in, okay? So 1, 2, 3, and 5, 7, 8, 9, 10, possibly 11 for my A students, 12, and 15. So when you get ready to make a journal entry, after you read the transaction type, you're going to tell me which one of these it is. Now, when cash comes into the business, it's 1 through 6. And of course, we're just doing 1 through 5. So anytime the transaction type says cash came into the business, cash is going to be debited. And then this is telling you what account is credited. If you issue common stock, credit common stock. If you got revenue, you credit revenue. If you collect it on receivable. So this transaction is telling you what account is debited and what account is credited. When we get to 7 through 11, you paid cash out. Okay, so cash is credited. So you gave up cash, and you either purchased an asset, or you paid a liability, or you paid an expense, you paid a dividend, and dividends are what the owners of the business get for their investment in stock. You could have done a refund. So once again, when you look at these transactions, either cash came in, you debit cash. It's a 1 through 6. Cash paid out, you credit cash. It's 7 through 11. 12, you purchase an asset using debt. That means you use your credit card rather than your debit card. And then in 15, you made a sale on account. That is, you did the work and someone owes you money. So you did the work, you earned the revenue, but you didn't get the cash right away. So we're going to look at an example of each one of these transactions. There's 20 of them, but you only got that, about 8 of them that we're working with now. Okay. Then we have this chart of accounts, which I told you to make a copy of. When you make a journal entry and you pick out accounts, they got to be on my chart of accounts. You do not create any accounts. You find an account over here, something that has a number by it. It's not asset purchase, it's what asset was purchased, what expense was paid. So when you have them do your debits and credits to make journal entries, you have to use an account on the sheet. So 2 sheets that you're gonna have copies for me on Thursday, in case I give you a quiz on Thursday. You're gonna have the transaction types, and you're gonna bold the ones, realizing that it's just 1 through 5, 7 through 11, 12, and 15. It's gonna be one of those right now. So you're gonna have to worry about all of them. Then you're gonna make sure you pick something off this chart of accounts. Okay, so let's look at some illustrations of recording journal entries. So remember, our goal is to be able to prepare those financial statements. So every time a financial transaction occurs, you got to make a journal entry, and there's going to be an account that you debit. It's going to have a number, the debit amount. It's going to have another number for the credit account, and it's going to be a transaction type. Our first transaction, what we invested $10,000 into the business. Okay, we invested $10,000 into the business. So what type of transaction is that? I go back up to my transaction types. Issued common stock, that's going to be a transaction type 1. So the type is 1. It tells me, since the type 1, I debit cash and I credit common stock. So basically, we're just debiting cash and crediting common stock. So now I got to go and get my account numbers. Let's move it slowly. So I see cash is 100 and common stock is what? 400. So to record this transaction, this first transaction, first thing I'm gonna put in here is the type. It's a type 1, okay? And of course, this is transaction 1 here. So I just put a 1 here to know that I'm working on number 1, journal entry 1. I'm gonna debit cash. Account number for cash is 100. And I'm gonna put debit cash. Then I said the account number for common stock was 400. So I'm gonna credit common stock for 400. And I'm done. So every time a financial transaction occurs, I determine the transaction type. When I go to the transaction types, it's telling me what account to debit and what account to credit. I get my numbers off of the chart of accounts, put my dollars in. Now I'm gonna do something with this later, but right now, all I want to happen is to record journal entries. So if you can't record these journal entries, you can't go any further. In my second journal entry, our rental car received $50,000. Cash received for car rental revenue, $50,000. So I've got to go back up here now and see if I can get a transaction type. And cash revenue received is 2. That's transaction type 2. I debit cash and I credit revenue, sales or fees, whatever we're using, whatever the type of business it is. So I know the account number for cash is what? 100, right? But now I need the account number for sales. And the account number for sales is 500. Account number for sales is 500. So in this next transaction, where I got 50,000 in cash, cash came in, the transaction type is 2. The account for cash is, account number for cash is still 100 cash. But now I have sales. I got sales, $50,000. So that account number and so I'm going to debit cash, 50,000. That's what I got. And I let them use my cards, rip my cards out for 50,000. This is all we're doing for the next 2 weeks. This week I'm talking. Next week you're talking with your journal entry. Okay, now we go to transaction number 3. And it says, I collected cash on account from corporate customers. So I go back up here to my types. I'm kind of going in order. Collection of accounts receivable, cash, that's the cash from corporate customers. That's the type 3 transaction. It says I debit cash and I credit account receivable. So you see, once I get the type, it's telling me what account to debit, what account to credit. I know cash is 100. I need to account for receivable is 110. So I'm gonna go down here to 3. The type is 3, so that's the first thing I'm gonna ask you, what's the type? Then I'm gonna ask you what account to debit, 100 cash. What account you credit, is that account receivable. And that was account 110. And our amount was how much? $20,000. So this is what we have to learn how to do, record journal entries. This is how you learn accounting. Every time there's a transaction, you got the debit cash and credit account receivable. So now we're up to transaction 4. I must have an A student in here, right? Do I have an A student? Do I have any A students today? Well, I don't have any A students. But what happened in 4? Receipt of a short-term working capital loan. Receipt of a short-term working capital loan. So the first thing I'm gonna do is go up here. And because cash is still coming in, I gotta be 1 through 6. So if cash is coming in, I got a short-term loan, what type is that probably?
Five.
That's a 5. That's a 5. Miriam is speaking up. Okay, so if it's a 5, it's telling me I'm debiting cash. And what am I crediting?
Notes payable.
Crediting notes payable. So I go down here. I know cash is 100. What's notes payable? I'm actually going to use 306 because it's a short-term note payable. So I'm going to use cash is 100. It's going to be a short-term note payable since I'm borrowing from the bank. So I'm going to debit cash, and I'm going to credit short-term note payable. And our amount was what, 25,000. And our type was what? It's a 5, correct? So I've done 1 through 4. I've done the first 4. In each case, cash came in, so I debited cash. Then I credited something else. So I got something of value cash. I paid something out. Okay. In the next group, 5, 6, 7, and 8, I am paying out cash, okay? I'm paying out cash. Okay. So let's see if we can handle some of these. So I paid out, in the first one, I paid what? I purchased supplies paying cash, 1,000. So if I purchase supplies paying cash, I'm no longer in 1 through 6. I'm down here in 7 through 11. So since I purchased supplies, the asset purchase was supplies. My type is 7. I'm a debit the asset purchase, credit cash.
Excuse me, Professor. It's 12:17 right now. I gotta go to my next class, so it's okay that I log off.
Yeah, I'm going to just do 2 more, then we'll go back over this on Thursday. So remember now, on Thursday we meet where? We meet out on Thursday.
At the building room 208.
Okay, so I'm going to just look at these last 2, just 2 more, dealing with supplies. So we purchased some supplies paying cash. Okay, so what account is supplies? That's going to be 130. So the supplies purchase is 1,000. So we're going to put 130 here for supplies. Then we're going to put 100 for cash. So you should have cash memorized about now. $1,000. I'm on the wrong line. And what was our type here? It was a 7, right? Our type was 7. Then I'm going to do just 1 more, which is I purchase supplies on account. So I'm purchasing supplies again, but I didn't pay cash. So in this case, purchase of an asset utilizing debt, I'm at 12. I got to debit the asset purchase, which is supplies, and I got to credit the liability created, which is accounts payable, since I bought it on account. So receivables are good. That's the money we're getting in. Payables is what we have to pay. And accounts payable is 301. So accounts payable is 301. So our transaction type is 12. So I'm just showing you the difference, what happens when we buy these supplies on account. And how much did we buy? 8,000. We're gonna debit supplies again, 130. And we're going to credit accounts payable. That's the 8,000. The 8,000. And what was our account number for account payable? Is that 301?
Yes.
Oh, 301.